All right, you ready to dig in? So this is a follow-up from the qualified plan tax trap video that I put out recently. This one's going to talk about the exit strategy. I scoured YouTube and I looked on the internet, and there's really nobody talking about a qualified plan exit strategy. Now, putting money into a qualified plan is justified if you're trying to get tax deductions in the current year because your income is high. And it's justified if you're trying to save money for retirement because, quite frankly, companies now don't have pension plans set up for their employees anymore. So it's all pushed into these types of qualified plans. So you've got the 401ks, right? In the definition of 401k, you've got, for the government employees, you've got thrift savings plans. For educators and municipalities, you've got 403bs. And then for privately held companies, small privately held companies, you might have something called an ESOP. You might have something called a KEO. I mean, there's all different types of qualified plans, and they're all pre-tax contributions, tax deferred growth, but completely taxable upon distribution in the future. So qualified plans, real quick recap, and remember to like, comment, share, subscribe, and let's have a conversation about this because I promise you no one's talking about it. There's also a link that's going to be in the description. If you meet the criteria for what I'm going to talk about in this video, set up a time, let's have a 15-minute phone call, and let's see if we can help you out. But qualified plans, they do two things. They defer the tax, or let me change that to what I like. They postpone the tax and the tax calculation. So the two main questions that I posed in the last video is, do you know what tax bracket you're going to be in retirement? And what deductions will you have when it's time to take the money out? And you don't know, right? So we've talked about this before, and here's the tax history, right? If you have a $2.5 million account balance, which is the example that I'm going to show you in this video, or $1 million account balance, if you're putting money into your qualified plan, you're going to be building up a quite large potential tax bomb, depending on where taxes are going to be in the future. So hold on one second, get rid of that. All right. So, if you're in a 30% tax bracket, you can see what your share of the government amount needs to be and what the government share is going to be. If you're in a 40% tax bracket in retirement, this could be federal and state combined, or if you live in a state that's just federal only with maybe some city taxes, but you're going to have to pay some sort of tax on those distributions. Either you are, and if you're trying to leave it to your loved ones, your children, to the next generation, they're going to pay an even larger tax. So the average of the top tax brackets for the last 100 plus years is 56.8%. And who knows what's going to happen, but we can kind of project what's going to happen when we look at this US debt clock. And I've been through this before. And this is all about an exit strategy for qualified plans, but I got to set the stage on why you need to be thinking about a proper exit strategy for your qualified plan, because the government has been sneaky with you. They've let you put money pre-tax, tax deferred, only to tax you on a much larger balance when you take the distribution at a much higher tax rate than where you were when you were getting the tax deductions to put it in. I'll come back and I'll show you that. But if I can zero in on this, and let me get my pointer. I tried to do this last time. So right now, our annual revenue, and maybe we can zoom in on that, is $4.8 trillion a year is our annual revenue. And it says our official spending budget is $6.7 trillion a year. Let me put it to you in different terms. If this was your household, you're making $48,000 a year, but spending $67,000 a year. Where does that difference go? Where does that extra $19,000 of spendable dollars go? It goes on credit cards, right? And so the government has built up a tremendous amount of credit card debt, and it's currently paying, look right here, let's zoom in on that. Total interest paid on an annual basis is $4.5 trillion. So of the revenue that the government is making of $4.8 trillion, almost, 90% of that money is going to pay the interest, which is why interest rates is such a key component of finances right now, not only for you, but also for the federal government. As interest rates rise, their debt spend gets higher and it consumes more of their annual budget, which is why interest rates will be going down. Make no mistake about it, interest rates will be going down. They're just trying to figure out the best way to get them back down, because the government does not want that. Now, I know the Fed is a separate entity. We can have a discussion about that later, but interest rates will be going down. But make no mistake about it, taxes will be going up for you and everybody else, because the government has to make more money. And the only way that they can think to make more money is to tax us more on our hard-earned dollars, right? It's not fair. It's just the way it is. So I did a little example, and let me change this. Well, look right here at the bottom. So I tried to figure out a way to get this to $1 million, to give you an example, assuming we're in a 40% tax bracket, pre-tax 40% tax bracket in retirement. So this is for my high income earners today, right? If you're in a low income, this makes even more sense because you're getting less of a deduction. I'll show you that here in a second. But assuming you're in a 40% tax bracket pre-retirement, 40%, this is federal and state combined, 40% in after tax or after retirement, you have $1 million balance. You got to pay the government $418,000. At some point, you got to pay them. And I'm going to show you that here in a spreadsheet that I'm going to bring out here in a little bit for a real world example. But if you were in a 40% tax bracket pre-retirement and you were saving $15,000 a year for 40 years, you only deferred or postponed $180,000 to pay the government $418,000 over your retirement lifetime if you were in a 40% tax bracket. I can make the argument for those that you were saying, well, John, I'm not in a 40% tax bracket right now. I'm only in a 20% tax bracket. Okay, well, a 20% tax bracket pre-retirement, and then if taxes go up and you're in a 40% tax bracket in retirement, it's even worse. You deferred or postponed over your lifetime of building money into your qualified plan. You only deferred, postponed $90,000 of taxes to have to pay them $400,000 of taxes. This is bonkers. It doesn't make sense. Contribute to your company plan as much as you can, as much as it makes sense for your current tax situation, because you need those tax deductions. Maybe they're giving you a match and you want to definitely take advantage of the match. But what is your exit strategy? Nobody is talking about the exit strategy. Nobody, except this video right here. So let's dig in. Remember, like, comment, share, subscribe. So here's what we need to figure out. How do we get taxable dollars, pre-tax, tax deferred, qualified plan dollars? How do we get those into a tax-free vehicle and minimize the impact of the taxes that is due to the federal government? Well, we have what's called a retirement asset financing technique, otherwise known as the raft strategy, to give it a little short name. So here's what we got. We got a 401k IRA qualified plan right here. And step one is distributions need to come out to you, the plan participant. And again, I'm going to show you this in a spreadsheet here in a second. Step two, give Caesar what Caesar's due. Caesar's going to get his tax. The IRS is going to get their tax. This is not a tax avoidance strategy. This is not a tax evasion strategy. Tax evasion gets you 5 to 10 years in prison. This is a different way to get money into a pre-tax vehicle. Then what's going to happen is we are going to take the remaining amount of your distribution, the after-tax portion of your distribution, and we're going to put it into an entity called an intentionally defective grantor trust. It's an entity separate and apart from you. We can get into those details when we have our phone call, but just know that we're going to set up a trust. Remember, this is how the wealthy keep their money. This is how the wealthy keep building more wealth. Think about the Rothschilds, not the Rothschilds, excuse me, the Rockefellers. The Rothschilds didn't do this. The Carnegies didn't do this. The Vanderbilts didn't do this, but this is a way to create more wealth or retain wealth for your family. Okay, so the net after-tax portion, step 3, is going to go into this entity. Step 4, we're going to get a lender. We have various lenders set up that is going to loan to this entity the amount equal to the tax that was paid to the government. So whatever amount went to the IRS here from your distribution, this lender is going to replenish that into this trust. And then we're going to use the trust over here to make a premium payment into a tax-deferred, tax-free distribution life insurance policy. Watch this video right here about a 10-minute lesson on life insurance. I've got other videos that talk about the characteristics of a life insurance policy. It's got 11 out of the 12 characteristics that you want in a vehicle, and it's the proper strategy if it makes sense for you. So step 5 is going to go into this life insurance policy. And then at some point in the future, we're going to use the policy cash value to pay off the trust and create tax-free distributions. So there's 6 steps in this transaction. And so let me show you what it looks like right here. Okay. So this is a 64-year-old male. He has $2.5 million in his qualified plan right now. This is a real plan. We're going to make some assumptions inside of this plan. And those assumptions right here is that we're going to earn 7% on his existing IRA, leaving it where it's at. And then we're going to make an assumption of the alternative strategy, the raft strategy. We're going to only earn 6% on the raft strategy. So we're giving the benefit of the doubt to the qualified plan, right? And so when we do this, here's what the cash flow looks like, or the flow of dollars. And again, set up a time to call me. I've got the link in the description section. We can talk about this in more detail, but there's a $410,000 a year distribution that we're going to make for 7 years. He's got $2.5 million in his plan. His taxes at 40% on a $410,000 distribution is $164,000 a year that needs to go in a 40% tax bracket that needs to go to Uncle Sam. The assumption I'm making on lending rates is it pretty well stress tested in this example. I'm assuming interest rates are going up over the next 10 years. And I just told you that interest rates will be going down. We just don't know how fast. So this is a very conservative approach to the borrowing. But if we borrow $164,000 at 7%, his interest expense for that year is $11,000, okay? And his interest expense in the second year is $23,000. Would you rather pay out of pocket $164,000 or $11,000? Then another $164,000 or $23,000? Then another $164,000 or $34,000, right? So the point is whatever's being paid here by the qualified plan distribution, we're replenishing that with a bank loan into this strategy. So over 7 years, we've borrowed $1.1 million from the bank. And in this example, in year 10, we're completely paying it back. So no more debt after 10 years. During that period of time, though, we've been having an additional benefit, which is not the primary purpose, but we've had a life insurance death benefit that if he passes away prematurely, his family is not only getting the remaining balance of what's existing in the IRA, but anywhere between $4 million to $2.5 million, depending on the timing of the death, in addition to what's already in the qualified plan. So that's an added benefit. But forget about the death benefit. And then once the debt is paid off from the bank financing that paid our taxes back into our plan, we're generating $240,000 a year of tax-free distributions for the rest of this person's life. All right, not to mention the death benefit that's being provided as well. And by the way, for those math people out there, based off of the interest paid out of pocket, the after-tax IRR are firmly in the 20% range as you get down past year 15, which is an unbelievable IRR for a strategy like this. The pre-tax equivalent is in the mid-30s on an annual basis for an IRR perspective. Again, we can geek out on this as much as you want to, but let's compare what this is really all about. Let's compare the taxes paid on strategies. And what I've got here is I've got the status quo. The status quo is leaving everything where it's at right now, earning 7%. I've got the status quo versus varying market returns, and I'll show you that here in a second. And then I've got the raft strategy, the retirement asset financing technique, the exit strategy for the qualified plan, and the differential between taxes paid, assuming a 40% tax bracket, to compare to the same distributions that we have for the retirement asset financing technique. And the story is that the raft strategy, by getting the taxes out of the way as soon as possible, and remember, we have a bank to replenish that, has at least $1 million less in taxes than both of the strategies. And really, it would be more, except both of these strategies actually end up running out of money when you look at the cash flow. So if I scroll down, both of the existing strategies, the status quo, leave it where it's at, they run out of money at some point. Versus the retirement asset financing technique, the raft strategy keeps paying tax-free distributions for the rest of the life of the individual. Not to mention, you look at what is going to the beneficiaries or wealth going to heirs over here on the right side of the page, wealth going to heirs. Well, remember, I told you the two status quo examples, the 7% and the varying returns, they actually run out of money at some point. So the heirs get nothing. So, well, now, granted, listen, he may die long before this happens. And so they'll get something over here, but who knows when they're going to die? And if you talk to most 64, 65-year-old people, really, they're not planning on being dead by age 85. They're looking at a 30, 35 year. This is the generation of people that more of them are going to live to age 100 than ever before, right? So is it suitable to have a plan that might run out of money in mid-90s? Or is it more suitable to have a plan that can pay tax-free income for the rest of that person's life and make sure that there's something left over for the family? Now, again, that may not be the goal. Fine, send all that money to charity or to your favorite nonprofit. It doesn't have to go to your family. But the point is, you're going to be making a prudent financial decision by doing it that way, right? And there's so many different ways we can look at it. Retirement plan taxes paid and how the raft strategy is significantly less. Cumulative spendable cash flow provided. Our raft strategy for this individual provides $6.5 million, which is substantially higher than the status quo of 7%. And we know it's not going to earn 7% every year versus the varying returns. You know, the varying returns is the one that we probably want to look at the most and compare it to. So let me see if I can find that in terms of what the assumed rates of return were in that varying returns. Here we go, status quo varying returns. So the assumption that I use in this varying returns is pretty fair. Positive 29% year one, positive 9% year two, positive 3% year three, negative 10, positive 25, positive 5, positive 20, positive 25, negative 14. I mean, this is pretty, I didn't start it with negative returns in the very beginning, and I'm just sprinkling it in, right? I mean, if you go back and look at what happened, this is pretty real for the S&P 500. But even with that, it's out of money. So to match the distributions of the retirement asset financing technique, it is out of money at age 88. Is that suitable? All right, we're talking about suitability for clients and the client's best interest. Is that really what is in the client's best interest, right? I mean, only you can answer this question, but the point of this video is to make sure that you are focusing on this right here. How do we minimize what your silent partner, the federal government, is going to get from your qualified plan? We cannot avoid it. Any money that's in there is going to be taxed. The question is going to be taxed sooner or later, right? And the clients that we're talking about, you know, they're earning significant dollars on an annual basis. So they need to put money into these qualified plans to minimize their taxes that year. But they're creating a future tax bomb. How do we get that money out? And that's what this strategy is really geared around and all about. So I'll go back, right? Qualified plans do two things. They defer the tax or postpone the tax and the tax calculation. What tax bracket will you be in retirement? What deductions will you have? And do you have an exit strategy that will get you out of paying taxes indefinitely? We got to give him what he's due. Let's do it as soon as possible, because I'll leave you with this. Taxes are only going to go up. There's nowhere else for them to go. Reach out to me, like, comment, share, subscribe. Let's have a discussion. I'll see you in the next video.